Welcome to Talk Tickers. Today we are doing a critical deep dive into the real estate sector. The mega merger between Compass Inc. and Anywhere Real Estate Inc. is finally complete.
And this is so much more than just another closed deal. This is, well, it's the birth of a residential real estate behemoth.
Yeah.
We're talking about the largest brokerage company in the U.S., created, almost overnight.
So our mission today, let's lay it out. We're going to analyze the structure of this new $10 billion giant.
Right. And then we need to get into the regulatory path. It was contentious, to say the least. There was a lot of political maneuvering that allowed this to close.
And finally, the big one for investors, the financial implications. Because the risk has now shifted completely from will the deal happen to can they actually execute?
Exactly. Integration risk.
Okay, let's start with the results snapshot. The deal officially closed last Friday, January 9th, 2026.
And the speed here is really noteworthy. It happened almost immediately after that standard 30-day federal antitrust review period expired.
Yeah.
That was January 2nd. The DOJ just, they let it pass without any formal objections.
The scale is just staggering. When this was announced back in September 2025, it was an all-stock deal valued at what, $1.6 billion?
Yeah, 1.6. But by the time it closed, the equity value had jumped to around $2 billion. And when you add in the debt Compass took on, the total value is about $5 billion. This new entity is a $10 billion force. No question.
And that scale means massive brand consolidation. We're not just talking about Compass and Anywhere. You're now looking at Coldwell Banker, Century 21, Corcoran, Sotheby's International Realty.
Bitter Homes and Gardens, ERA Real Estate, they're all under one single umbrella now.
So how did the market react?
It's interesting. Compass stock, ticker COMP, it finished the day up 4.73%. It closed at $12.84.
Okay, so that sounds like optimism.
Well, you have to look closer. The trading volume surged. It was up 227% above average. To me, that says investors are relieved the deal is gone, but now all the focus is on execution.
Wait, hold on. If the stock jumped, isn't that a good sign? What should we be looking for in the next, say, couple of quarters to see if investors are right to be a little skeptical?
That is the perfect question. That initial jump is just a relief rally. The risk of the deal failing is gone. But the skepticism is baked into the operating reality. I mean, look at Anywhere. They brought in nearly $184 billion in 2024 sales volume. That's huge. But they were acquired because they were vulnerable, not because they were thriving. We need to watch cash flow and, I think more importantly, agent headcount.
That's a great point. And it brings us to the history of Anywhere, which used to be Realogy. You have to understand the corporate chaos there to see why they were a target.
Exactly. You don't need the whole long chronology, just the key points. In 2024, they did $5.69 billion in revenue. Sounds great.
Until you look at the bottom line.
Right. A net loss of $128 million. You combine that loss with their legal baggage, and it's pretty clear they were negotiating from a position of, profound weakness.
And that legal baggage was the $83.5 million settlement they paid in 2024. It was over antitrust claims that their policies were, inflating buyer-broker commissions. So they were losing money and facing massive legal bills.
And that's when Compass swooped in. What's really fascinating here is how Compass was already trying to assert control over the whole industry, even before this deal.
Through their private listings network.
Exactly. This controversial strategy where instead of putting a new listing straight onto the MLS or Zillow, Compass agents would market it privately among themselves first.
Which is just a pure power play for control over attention and data. They were trying to challenge Zillow's dominance.
And Zillow, of course, banned those kinds of listings, saying it was for market transparency. But everyone in the industry saw it for what it was, an aggressive attempt by Compass to control the funnel.
So if you connect that aggressive strategy to the regulatory path for this merger, the quick approval really does raise some major questions.
It absolutely does. We now know that the Justice Department's own antitrust staff, the career experts, not the political appointees, they internally recommended an in-depth investigation. They were concerned.
And this is where the politics come in.
Yeah.
Senior officials in the Trump administration overruled those staff concerns. They just let the waiting period expire. No deeper probe. That's why this deal closed so fast.
Yeah, and it doesn't help that Compass hired a well-known conservative lawyer, Mike Davis, to argue their case above the antitrust chief. It really suggests that, lobbying played a decisive role here.
And it wasn't just the DOJ staff raising red flags. We saw bipartisan concern. Senators Warren and Wyden, for example, urged the DOJ and the FTC to scrutinize the deal.
They warned it could raise barriers for smaller firms and ultimately increase housing costs for consumers.
And the data backs up those fears.
It really does. We're not talking about small market shifts.
Yeah.
We're talking about what look like local monopolies. The combined company now controls, by dollar volume, over 80% of the market in Manhattan.
80%.
Over 70% in Northern California and over 60% in Washington, D.C.
Wow. How does an 80% market share in a place like Manhattan actually help them with their...
Give them enormous pricing power.
Yeah.
So they can, in theory, keep commission splits high for themselves while they're slashing their own internal costs.
Yeah.
But, and this is a big but, it also paints a massive regulatory target on their back. It's their greatest asset and their greatest vulnerability.
Okay, so let's move to the investor context. The regulatory hurdle is cleared, but the financial engineering it took to get this done has created a new, maybe even bigger obstacle: the debt.
The debt load is significant. The combined company is now managing about $2.1 billion in debt. That gives them a debt-to-earnings leverage ratio of 4.4 times. So for every dollar of annual profit, they have $4.40 in debt. That's high.
And to service that debt, they issued $850 million in convertible senior notes. But the immediate mandate is just brutal. They have to cut $225 million in costs.
And those cuts create what we're calling the core operational headwind. It's the human problem, agent uncertainty and attrition risk.
Right.
Most industry analysis says this merger is a power play for market control. It has nothing to do with empowering agents. So that debt and that cost-cutting number will almost certainly translate into less agent support, smaller marketing budgets, and worse commission splits.
So the big question is, how does this new giant manage the very agents who generate all the revenue? They have to keep the top performers.
That's the critical tension. And we can see the risk already if we look at existing Compass compensation models. They use these non-transparent negotiable splits that tend to decrease over time. There was one analysis that showed just a 1% reduction in revenue paid to agents over 2 years saved Compass $9.5 million.
So they're already comfortable shaving margins off their agents.
Yes. And they make it incredibly hard for high-performing agents to leave. We're talking about aggressive clawback provisions that can last 2 to 3 years, even on a 1-year contract.
I saw an example of that. A New York agent tried to leave and was facing a potential penalty of $400,000 because of these clauses.
Exactly. So the agents are trapped, they're facing less support, shrinking commissions, but the cost of walking away is just financially punitive.
And when you look at the rest of the industry, this high leverage model is, well, it's an outlier. There's a major publicly traded competitor that operates with zero debt. And it's the only brokerage that has been cumulatively profitable over the last 5 years.
That comparison really suggests this new combined Compass Anywhere model might be structurally unsustainable without some truly painful cuts.
So the focus for any investor is pure execution. Can they find those $225 million in savings, integrate all those duplicative brands without starting a catastrophic agent exodus? It's a real tightrope walk.
Which brings us nicely to our final segment, where we try to synthesize all this operational risk into a tangible thought exercise.
Okay, this is not financial advice. This segment is purely an intellectual exercise. We develop an outrageous but plausible trade idea based on the risks we've uncovered. The goal here is just to provoke thought about how market forces might react.
Right. So the thesis here is all about operational failure. The merger closing took away one risk, but it exposed the instability inside the structure. You've got the $2.1 billion in debt, the 4.4 times leverage, and this absolute mandate for deep cuts that falls directly on the agents, the very agents who are already suspicious of the company. It just screams execution failure risk.
So what's the specific trade that bets on that failure?
We initiate a long-short pair trade. You go short Compass, COMP, and long Zillow Group, ZG.
Okay, justify that pairing for us.
It's a direct bet on industry chaos. You short COMP because you're betting that the cost-cutting needed to service the debt-slashing splits, cutting support will cause high-performing agents from the old Anywhere brands to leave. That would cause revenue to shrink way more than any synergy they expect. And you go long ZG because you're betting that if this new brokerage giant struggles to manage its listings and its agents, Zillow is the natural beneficiary. Zillow remains the stable, dominant platform for consumers. It's a pure bet on fragmentation winning out over a forced, debt-laden consolidation.
That's a compelling thesis. You're betting the human problem, agent retention, will outweigh any benefit from market concentration. And that really sums up the whole story here. The largest U.S. brokerage is born, but its high leverage and controversial approval process have set the stage for an incredibly risky period of integration.
Indeed. And the final thought for you, the listener, goes beyond the ticker. It's more about policy. Does the fast-track clearance of a merger with this level of market concentration, despite all the internal concerns, set a dangerous precedent? One that prioritizes corporate consolidation over competition in a market as essential as housing? That's really the question for the next decade.
And we invite you to think about how quickly this new company will be forced to rationalize that huge portfolio of brands. Will those cuts be manageable, or will they trigger the very agent exodus they have to fear? Thanks for joining us for the deep dive.